Good morning, everyone, and welcome to the Amati Strategic Innovation Fund update. Firstly, many thanks for taking the time to join us this morning. It's very much appreciated as usual. My name's John William. I'm part of the sales and marketing team here at Amati. And today I'm joined by two fund managers on the fund, Mikhail Zevrev and Graham Bank, both of who will be presenting today. But before we get on to the main part of the presentation, I thought it'd be worth just touching on a few aspects of the fund, given that the fund may be new to some of you and you may be less familiar. So we launched the fund back in May of this year, and it's certainly been a challenging investment time to sort of launch the fund. And as you'll know, areas of innovation, tech and growth were going through a derating at the time, and very savage derating in some areas of the market. Now, of course, the fund hasn't been exposed to the full extent of that sell-off, but nonetheless, we kind of think and believe the fund's performed really relatively well in the context of those markets, having returned around 3% positive return for investors since launch. I think that kind of brings on to two sort of key points, really, with regard to the fund. Firstly, that there is definitely opportunities arising in the market from rather indiscriminate sell-off in many cases, and the team will talk very much about where they see those opportunities and where the value is emerging. And secondly, and perhaps more importantly, is what the fund's looking to deliver for investors and what the team are looking to deliver for clients. Their definition of innovation is perhaps broader than you might first expect on a fund like this, and certainly broader than many other innovation funds you may be familiar with. And that's really very much by design. You know, the team as a result have a broader universe of stocks to pick from. It allows a more flexible approach in terms of managing the fund. In terms of navigating through what are the best opportunities within different cycles or even different investment environments that we've seen as recently. So it's very much kind of looking to take advantage of those long-term opportunities, but looking to mitigate some of the risk and volatility that come with investing in global equities. So hopefully, for investors, it's a very rewarding strategy to invest in over the longer term. But what we're looking to do is make it more palatable and sort of reduce the volatility of that return profile on the shorter term. The presentation will last for about 30 minutes. Please do submit your questions on the Q&A bar as usual. We will take as many of those as we can at the end of the presentation. If we don't happen to get to your particular question, fear not, we will get back to you once the event has finished. I think without further ado, I'll pass over to Mikhail.
Yes, thank you very much, and thanks for your interest. Of course, the bulk of this conversation will be talking about what we're seeing in the markets, the opportunities we are interested in, excited about, or choose not to take advantage of, or in fact think they're not opportunities at all. But for those who are less familiar with the fund, and just to kind of set a scene, I just wanted to remind you, the audience, what we're looking to do, what makes us different as innovation investors. So this slide is all about that. We are investing in what we call pioneers, enablers, and adopters of innovation. So companies that benefit from innovation in different ways, and where this benefit is not priced in by the market consensus. So why we're doing that and what makes us different in pursuing that? Well, first and foremost, it's a very compelling opportunity set. It's large and it's growing. The demand for innovation is going up. More and more challenges that we're facing as consumers, as businesses, as society at large are answered with innovation. But the supply of innovation is going up as well. We are anniversarying scientific breakthroughs in areas of material science, semiconductor physics, life sciences that are really opening up new innovation opportunities on the commercial level, and we're seeing that and a proliferation of discoveries, new products, etc. But most importantly, this opportunity set is mispriced. Both our experience and a growing body of academic evidence suggests that the complexity and the change associated with innovation is often not fully understood by the market consensus, and the full implications of that are not fully priced in, which for us as active investors means there's an alpha opportunity for us to exploit. So our approach embraces that complexity. We like getting deep into the detail of what these innovative companies do, the nature of the innovation they pursue. We think we're well equipped to do that as a firm and as a team, because that's where the high conviction ideas come from. That's where mispricing comes from. But as John alluded in the beginning of this conversation, we also have a broader approach to where we look for that innovation. We're not just interested in, if you like, high-risk inventors what we call pioneers of innovation. We're equally interested in picks and shovel suppliers to those what we call enablers, or even companies that adopt innovation and benefit from that innovation laterally in what's already a well-established, profitable, um, uh, uh, growing business. So that approach obviously broadens our opportunity set, which is good in and of itself, but most importantly, it diversifies the risk in the portfolio. It balances the portfolio risk away from this high risk, potentially high reward, but certainly very high risk pioneer only approach. And the third point to make is on this slide is um, as a team we have the experience. We've done this before. We between us we have many years of investing in innovation, technological change. We delivered top quartile track record, and for a variety of very specific reasons, we think Amati is a fantastic platform to do this work on. It brings a very distinct informational advantage to us as investors. And just a few headline stats about the fund as it stands today. We think it's a very differentiated portfolio, both from other global funds you might consider and from other innovation funds. Our weighted average cap is 22 billion, so it's a liquid, it's not a small cap fund, but it's certainly biased away from the ubiquitous consensus mega caps you can get in many other places. You know, the Amazons, the Apples, the Microsofts, the Alphabets of this world. Nothing wrong with those companies. We may own them from time to time, but we certainly think there's more to innovation opportunity than those stocks. This is not a single sector portfolio. It's a multi-sector fund with 5 sectors represented, so truly global fund. And we clearly demonstrate our valuation discipline, even though, as you will see, we pursue some really interesting high growth innovation areas. The fund has a reasonable PE multiple of 16 times and pretty robust 5% free cash flow yield on average. It's a focused high conviction portfolio with 31 holdings at the moment, and we're guiding investors to 30 to 40, and we have an active share of 99%. So we are very, very different from the benchmark. A few words on the team. 2 of us are here. Gareth Blades, who worked with us, isn't on the call just now. We between us have about meaningfully more than 50 years of experience in investing. As you can see here, we've spent some time running multi-billion global equity franchises and some of the largest global asset managers. The logos on the left-hand side refer to some of our past experience, and we're excited to bring this opportunity, this experience, I should say, to Amati and build this new product here. We enjoy the complexity and the research of that complexity that innovation brings. We have a mixture of technical and life sciences degrees between us that we think equips us to do a good job with that. But we're also trying to keep our business heads on. We realize that the innovation isn't just about exciting science. It's also about profitable cash generative business model that creates shareholder value as a result of that science, if you like. And we have finance economics degrees between us to do that. And we have delivered top quartile performance in global equities before on a multi-year type horizons. A lot of that performance and a lot of that approach in our past came from investing in innovation and technological change. So we are really playing to our strengths here at Amati. But the most important thing that I wanted to mention here is building this on Amati platform brings some really unique informational advantages to the work we're doing. And the reason is simple. UK really punches above its weight. It's one of the global centers of excellence in innovation in areas like material science, areas of tech, specialist engineering, life sciences. Numerous examples of breakthroughs that UK companies or academic teams delivered in that space. And the closest you get to that is through smaller companies and venture capital funded companies. And of course, Amati is a category leader in the VCT venture capital trust space and the smaller companies space. We have this fantastic access to founders, senior executives, technical experts in the companies at the very forefront of technological change and innovation in their industries. And with the relationships, really close relationships, often built over the years. And as a global team, as a global innovation team, working alongside our VCT and small cap colleagues, we have full benefit of those insights. We take those insights and bring them to the global opportunity set, and that allows us to make much more informed global equity stock picks than would have been the case otherwise. I mean, we knew that coming in. That was the reason we're here, but we've really been blown away by the level of access we got. Just in a couple of months, of the past months that I could think of at this point. We had a founder of the company that specializes in antennas for industrial connectivity, talking to us in depth about what's happening in the Internet of Things space, which is a very exciting growth area and innovation. We had a leading management team of bespoke semiconductor design company talking to us about the work they're doing with wireless infrastructure and satellite communications. Again, really exciting growth area globally. And we're really privileged. In fact, we've been discussing just recently that even though we worked with some of the largest asset managers in the past, we never really had as much insight into this front line of innovation as we had in the first several months that we worked at Amati Global Investors. So really exciting and very tangible differentiating point and informational advantage here.
Yeah, and as Mikhail mentioned earlier, we're not just looking for those cutting-edge disruptive innovators. We're really looking for incremental change and development as well. So we do that by identifying a full range of companies that are exposed to or involved in a particular innovation frontier, and that means we're looking for not just the companies that are creating the innovation in the first place, but also for those fast-following companies that adopt it, or the supportive companies who enable the development and the implementation of that innovation. And on this slide, you can see we've given you the example of the EV market. Everyone knows Tesla is a very well-known company in this sector. This is really the innovation driver for EV, but that's not the only way to invest in this growth area. You can see here two other names: Volkswagen, which is we consider a sort of fast follower or an adopter of innovation. Volkswagen will incidentally is likely to produce more electric vehicles than Tesla by 2025. Yet if you look on the slide, you can see the difference in the earnings multiple for that stock. Very significantly different and much higher free cash flow yield. So you're able to get exposure to the development without having to pay the very high upfront costs or take the binary risk that's often associated with investing in the pioneer. And likewise, if you look at the stock in the middle, Infineon, which is an enabler, it's a supporting business, it's a semiconductor company. Infineon will supply semiconductors to whichever company is the winner in this market. They don't care. We're not taking any binary risk with Infineon. And again, you're getting exposure to that significant growth opportunity, but at basically a market PE. So we think that by taking this approach and by looking across the full spectrum of different investment opportunities, we can choose where we see the best risk reward. And we can structure the portfolio so that we have a mixture of adopters, enablers, and pioneers, which gives us a sort of more balanced risk approach. In this case, we did invest in Infineon and Volkswagen, and you can see underneath that so far year to date, they've both done better than Tesla. So it doesn't always pay to buy the kind of innovative poster child for any particular innovation frontier. Now, this approach has served us well for the lifespan so far of the fund. But yes, sorry, go to the next slide. You can see over the last few years, we know that riskier equities had done particularly well. They ran up because of the very low interest rate environment, which sort of pushed investors further and further out along the risk curve. And that led to companies coming to the market that historically wouldn't really have been listed businesses. They would have been in the sort of private equity environment. But now, because rates are starting to move back to a more normalized environment, the dynamic has really changed. And you can see how those companies, those sort of profitless, higher risk companies have performed. That's the line at the bottom, the profitless tech line. And you can see the performance of that basket compared to the index overall, the ACWI, which is our benchmark, and even to some of the sort of more, theoretically risky parts of the market like IT and semiconductors. So we think that gives you a good understanding of kind of, why the market has normalized. And we're just going to dig into a little bit more into the next slide about how things are likely to develop from here.
So the relationship between interest rates and capital availability and the performance of growth and innovation stocks is not new. Obviously, the last several years have been a dramatic boom and reversal that illustrated that very clearly. But if you look at the much longer period of time, and the chart here on the left-hand side shows 2 decades worth of history, we're measuring here, it's a complex chart, so let me unpack exactly what's going on here. But we're measuring here outperformance of growth stocks using S&P 500 growth index as a proxy, compared to the broader market, again, using S&P 500 as a proxy, simply because we have a longer data for that. And you can see that if you plot the outperformance of growth of a broader market against the interest rate expectations, in this case, 10-year treasury yield, it's not quite a perfect correlation, but it's a very strong correlation. And it's not just a matter of the last several years. This dynamic, this relationship between growth outperformance and interest rate, lower for longer interest rate expectations, has been in place for some time. And the mechanics of that, to some extent, are very clear. If you're conducting a DCF or analysis of a company, if you think about the value of the future cash flows, and interest rates are near zero, even cash flows far into the future become very valuable today. Whereas if you have a real cost of capital, a real alternatives of where to earn interest in the near term, and discount those future cash flows at a higher rate, they discount to very little and almost nothing. So this long duration assets, this kind of very high growth but not yet profitable concept stocks, if you like, become a lot more valuable in much lower interest rate environments. And market conflated those things. I mean, for sure, there's been a lot of innovation that manifested itself over the past couple of decades, created a lot of value, and this is a real transformative, game-changing, industry-changing process. And that value is real and has certainly been created and will continue to be created. That's the value we're pursuing. But that was combined in a way that market didn't fully appreciate for a long time, with a lower for longer interest rate bet, effectively. And now it normalized. And it's not just a matter of style rotation and kind of a shorter term, interest rate expectation dynamics. It's also a matter of financial viability. Graham alluded to this earlier. A lot of companies came to market and raised money in the market that really had no business being listed. And you can see that just looking at the US IPO capital raised over the past couple of years. These are unprecedented numbers. This was not a normal environment. And this is just IPOs, by the way. It's not counting follow-on fundraising or the newly fashionable and hopefully soon to be extinct mechanics of SPAC IPOs, where you can go public via a merger, and a lot less scrutiny is applied to that. So we as we say here slightly facetiously, every dream got funded and every mistake got forgiven in this free capital environment. That's not normal. We think going forward the environment will be a bit different, and we designed this approach, and in fact I've been running money like this for a long time, with the view to fit that more normalized environment.
Yeah, and we think the market's at quite an interesting pivotal point here, and could go one of two ways. I mean, we could be at a situation where the interest rate cycle has peaked. We're going to go back to ultra low interest rate sort of expansionary monetary scenario, which would mean that we would return to an environment where a high risk growth model becomes popular and we get more of these unproven business models coming back to the market. We think that's very unlikely. We think the market's kind of learned that mistake. If anything, we believe the interest rate cycle here normalizes, which means that investors start to refocus on profits, cash generation, old-fashioned things like that, valuation discipline. And in that environment, we think there's a premium that's paid for quality. And we thought it would be helpful just to bring some of these things to life with some examples. On this slide, we've shown you some of the, just a couple of examples of some of those companies that really historically would have been private equity businesses rather than listed companies. Carvana, many of you will be familiar with, which was a sort of very innovative way to sell used cars, generated a huge amount of enthusiasm and a very high valuation, and even managed to take on an enormous amount of debt. But the problem with these companies is that they're not producing cash or profits for a long time in the future, and the market is in a normalized interest rate environment. The market doesn't have the patience for that. Likewise, Joby, We have nothing against these companies. We think particularly Joby is quite an interesting business. It's in the ride-sharing aviation market. But again, you're taking an enormous amount of risk for a business model that's unproven. For example, my father wrote a lot of the aviation regulation for Australia, and his view is that this is a very difficult area for regulators to get their hands around, because particularly in the UK we have incredibly dense airspace, and so regulators are really struggling. So, when you've got risks like that are very difficult to quantify, and a company not making any profits, this is a difficult thing for listed equity investors to really to cope with.
Conversely, the sell-off that had occurred this year and tail end of last year is starting to present opportunities that are coming within our sort of field of vision in terms of the valuation metrics and the business fundamentals. So we're busier looking at this oversold opportunities and looking for places where we can take advantage of the sell-off. But not all of them pass the test quite yet. So one of the prime examples of this category of maybes, as we call them, is a company called Unity, which is an industry-leading graphics engine for video games. This really had a triple whammy on the way up. It was a high growth, not yet profitable, but a high growth, exciting technology. So it was priced up, way above maybe its merit at that point. For this sort of future growth opportunity. It also was a COVID beneficiary. We all played, well, the broader population, so maybe not myself, played a lot more computer games during COVID. And of course, these guys are, as engine suppliers, graphics engine suppliers into that space, benefited from that growth as well. And the notion of metaverse, which has been born over the past several years, this was one of the go-to metaverse stocks. They create those digital sort of 3D virtual reality worlds that we thought we will inhabit for longer during COVID than turned out to be the case. So all these things are now unwinding. The stock is 80%, over 80% from its peak, but it is a real business. It's going to be profitable and free cash flow generative, and next year based on the consensus expectations. So normally it'd be something that we would be paying a lot closer attention to, and yet we're still on the sidelines. We still think metaverse is an unproven model. We're not entirely sure what the business model will be to begin with. The company is making fantastic tools for game developers and video effects developers for films and architects and product designers, but it still makes a lot of money from mobile advertising, which is not a very robust business model. It's quite fragile and vulnerable to some of the privacy changes that are going in the mobile space. And at 175 times PE for the next year, it's still a demanding valuation level. So we are staying on the sidelines for this one.
Yeah, but unlike Unity, which was a kind of transitory beneficiary of COVID, we think some companies are more permanent beneficiaries. So this company, QIAGEN, provides molecular testing and diagnostic kits for labs and life science organizations around the world. COVID really drove up demand for their test equipment. So they were effectively able to seed the market with these very versatile tools. And now QIAGEN's able to sell additional test kits and reagents for other uses. So here you've got a very innovative business with strong market position, very strong installed base, high recurring revenues, and you're getting all that for just quite a small premium to the market average multiple. So we think a really interesting business.
We are interested in picking up some of this oversold, if like babies thrown out with the bathwater. And here are a couple of examples of areas we did establish a position, in fact, added to the stocks recently. Both are semiconductor companies. One, Nordic Semiconductor, is a category leader by far in low power connectivity chips. So as more and more things get connected, and they supply into wearables, into smart home devices, but also into industrial IoT applications. As more and more things get connected, they need to be connected often with a battery power, with a lot of power limitations on connectivity. And Nordic developed technology that really leads the market in that space. And of course, IoT, general wireless connectivity, keeps growing and growing. Umbrella is a category leader in its own field. It's in its own niche. It's a leading computer vision chip supplier, again for low power, low footprint applications. So NVIDIA might be the dominant player in artificial intelligence in the data center, but if you want your computer vision, your kind of smart analytics to reside in a small device like a security camera, for example, Umbrella is a go-to semiconductor supplier for many of those applications. And of course, they are going into a really interesting and the most lucrative potentially for them market with the automakers as an enabler of initially automated driver assistance and eventually autonomous driving. And that's the biggest target market for them of them all. And both companies are profitable, cash generative businesses. They have strong balance sheets. And for the growth opportunity that we're seeing, both Nordic's 24 times earnings multiple and Umbrella's optically high 50 times earnings multiple, but before all the automotive opportunity even started to flow through their revenues, we think this is after more than 50% or about 50% fall from the peak. I think this is now the price worth paying. So we've been fishing in this oversold stocks over the past couple of months. Conversely, some innovators never missed a beat and continue to deliver, and that's the beauty of innovation at the right price. If an innovation adds real value to the customer, creates real value for the business, its adoption often becomes a technological inevitability, and it becomes insensitive to a number of macroeconomic headwinds. And equally, if you buy that innovation a business, if you buy that innovation stock at a reasonable price, then that makes this investment immune to kind of sentiment-driven sell-offs or wholesale deratings like the one we've experienced year to date. So here are two examples of that. Portfolio positions, which remain one of our top holdings. PTC makes digital tools for industrial manufacturing, anything from product design and simulation through to product lifecycle management, after-sales service, including the IoT connectivity with the devices once they're installed in the field. It's a rapidly growing area. The stock is growing double-digit on the revenue and earnings line, and even though it's 23 times today and was a bit cheaper when we first established the position, it's still a compelling valuation in our opinion. And the stock's done really well. It's actually up a bit year to date. It's more than 30% ahead of the MSCI software index. And then on the other example, Booz Allen Hamilton, it's an IT service supplier as well as technology provider, but their target market, defense and intelligence, is rapidly digitizing as well. Unfortunately, the defense spending is going up overall for obvious reasons, given the increasingly less safe world we live in. But within that defense spending, more and more dollars are allocated to areas like signal intelligence, like satellite imagery analytics, and other kind of cyber and IT tools. And Booz Allen Hamilton is really a category leader in that space.
And two other companies that we think are sort of structural winners, companies that are benefiting from a significant shift in this case, in investment into energy infrastructure. Everyone's aware of the sort of transition to lower carbon forms of energy production, wind farms and solar, etc. All of those have to be connected to the grid. And as we use more and more heat pumps and electric vehicles, we have to upgrade the local distribution grid as well as the transmission. So two companies that we really like that are directly exposed to that. Prysmian makes the high voltage cables, as well as other areas like fiber optics, which is another area we're seeing significant investment. And Hubble, a US company, makes a lot of the components that go into grid infrastructure. Both of these we think have got a decade potentially of growth ahead of them as the world really goes through that transition. Prysmian, interestingly, I had a meeting with the company just a week or so ago, and they said they're seeing interest in some quite amazing projects. Things like Singapore is talking about connecting via high voltage cable all the way to a solar farm in Australia. There's potential for the UK to have a direct link to Morocco, again for solar energy generation. So there's a huge amount of potential for these businesses, which and they're not really reliant on the underlying economic cycle. This investment is happening regardless of where interest rates go. And then we talked earlier about this is very much a global fund. You can see here the split across geographies as well as across sectors. This is certainly not just a technology-only fund, and that's obviously by design. We have 5 sectors exposed at the moment, and there can be more. Market cap-wise, as Mikhail said at the start, we're not really targeting the mega cap part of the market. We think you can get exposure to Apple and Facebook or Meta, in lots of other places. What we're trying to do is dig down a little bit more into the weeds and find companies that have specific drivers where we can really isolate the growth opportunity. And that tends to be more around what we call the mid-cap part of the market, sort of $10 to $30 billion. So not UK mid-cap, more sort of US mid-cap. And that's really our prime hunting ground. And you can see that in the market cap split. But I draw your attention to the category split chart at the bottom right there. This is what we talked about earlier, the sort of split between enablers, adopters, and pioneers. This will move around depending on where we're finding the best opportunities in the market at the time. It's really about being able to identify that optimum risk reward. And obviously at the start of this year, a lot of those pioneers were very expensive, a lot of hope priced into them. But as the market has come down and we saw those profitless tech numbers earlier, there are some businesses there, companies like Unity, that we're starting to take notice of and be interested in. So that split will move around over time. But the point is, it gives us a great way of balancing risk across the portfolio that we don't think is true of many other similar portfolios. And the next slide, just gives us some numbers around the fund. Again, we're not value investors, but we are very valuation aware. So you can see the forward ratio, PE ratio for the fund is not very dissimilar to the benchmark, yet focused on significantly more EPS growth. Again, buying very profitable cash generative companies, strong free cash flow yield, lowly indebted businesses. These companies are self-funding. So with strong balance sheets, it means they're not dependent on equity markets to grow. And that's very important from our perspective.
So in summary, we think innovation remains a compelling opportunity. With recent sell-off notwithstanding, there's a growing opportunity set. It's evergreen. There's a clear market inefficiency around that, which means that active investors can deliver outperformance, can deliver alpha. We have a team that is well equipped to tackle that opportunity in terms of our background, in terms of our experience in the innovation space and in running concentrated, high conviction global portfolios. Track record from running multi-billion global equity franchises at some of the largest asset managers in the world and delivering top quartile performance for our clients from those areas of technological change and innovation. But we also think, and I can't emphasize that enough, that building that on Amati platform is really quite special. There's access to insights from those founder entrepreneurs, those technical experts, those executives from the leading edge, from the smaller companies at the forefront of these changing industries, and then taking those insights into the global opportunity set and finding global winners is really valuable. Our approach is broader. It allows us to balance risk more than a pure pioneer-led approach would have been. But equally, even though we pursue that complexity, we're very happy in, as you have seen, to look at really exciting, game-changing growth areas and technology, healthcare, and industrials. We couple that with our valuation discipline, our focus on profitability and cash generation, that we think increasingly will become very important in the market. The benefits, this evergreen benefits of innovation, will accrue more and more to companies that can fund their own growth rather than depend on the kindness of capital markets to provide them with funding. And the result of that is high conviction, very high active share, very differentiated portfolio, but with a balanced risk and very palatable overall valuation metrics. So we're really excited what the future brings. We're excited about the opportunities we can see in the market today. And we ourselves are significant investors in the fund, is a very substantial part of our personal capital is invested in the strategy. So we're certainly putting our money where our mouth is. So with this, I'll stop. Thanks very much for listening, and I'll pass it on to John for Q&A.
Thank you both, very much appreciated. We have got some questions come in, so we'll kick off with this one first, because you kind of touched about being able to evolve between pioneers, enablers, adopters. And someone asking here, how do you see this mix changing, and how would it have looked a year ago? Or do you have a feel for how it would have looked a year ago?
So we had a year ago, not quite a year ago, but yeah, around about a year ago, we already started putting a model portfolio together, and it was a lot more adopter enabler heavy. Like Graham said, pioneers were just so expensive in so many places. It was hard to argue that our view was a non-consensus view. And well, certainly I'm speaking for myself. For me, it was hard to argue that my view was a non-consensus view on even some of the portfolio holdings that ended up in the portfolio today. So yes, a year ago it would have been more enabler and adopter heavy. Now the pioneer weight might start creeping up, but we're ultimately led by bottom-up opportunity analysis, not some preconceived mix.
Okay, we move on to the next question here. We have one kind of asking basically on the portfolio side about return on capital employed. And someone here is saying, intuitively, I would have thought the return on capital employed of the portfolio might have been higher than the benchmark. So really kind of any comments on that, or any guidance as to how that figure's come out?
We have we didn't cover our process in great detail, focusing more on some of the opportunities we're looking at, but we have this concept we call a roadmap to quality, which is, what does innovation success look like? You're right, it should look like a higher growth, higher margin, higher return on capital. But there's a roadmap to that. Not all of the companies are already there. Some are on their journey to that point. So we're open to companies that are still on that journey, so they're not earning their full potential, if you like. But we want to see a roadmap to that quality over the next 3 to 5 year time horizon. So some of the stocks that pull down both return capital employed and EBIT margin, which probably you have in mind with your question as well. Some of the stocks that pull that down a little bit below benchmark are companies that are still on that journey, but they're already profitable and cash generative.
Okay, thank you for that. Just quickly on when you were talking about the buckets of pioneers, enablers, adopters, and you had the VW slide. Someone just asking here, given the relative value in VW versus say something like a Tesla, what's going to be needed to sort of realize that value, or why do you think that's the case?
I guess the passage of time and delivery of those milestones, like Graham said, they on their targets by 25, they will be producing more EVs than Tesla. And if you look at Audi e-tron or Porsche Taycan, but even Volkswagen ID3, ID4, ID5, and ID Buzz, these models are well received critically. They're very popular. They're selling out. I think Volkswagen achieved their target of selling 500,000 of vehicles and a year early than of electric vehicles, a year early than they meant. And in the meantime, some of the new entrants into EV space are demonstrating that building an auto business isn't as simple as maybe they have led their investors to believe. With seeing recalls by Rivian, for example, a US automaker focusing on SUVs, EV SUVs. The traditional automakers have turned out to have a lot more to offer in that space than market initially believed. So the more they get to demonstrate that for sales and profitability, the more market will come around to our point of view, we believe.
Okay, that's good. We have one kind of general question here on automation. So someone's asking, what is your main exposure to automation as a theme?
We have. I suppose the most direct one is a company called Zebra, which is involved in providing equipment for things like supply chain automation. So they supply machine vision equipment into both autonomous mobile robots as well as sort of production line type of distribution equipment or supply chain equipment. So they're not a maker of sort of robotic arms, but they're very much involved in the sort of the shift to automation in that sector. The other one's probably PTC, which is the one that Mikhail discussed earlier. They're involved a lot in providing software and services to companies that are designing automation equipment, as well as lots of other areas. But that's definitely a part of their sort of growth trajectory.
I'd probably add to that in our process, we're thematically aware. We're aware that automation is a growth area, but we like to look for more granular, what we call innovation frontiers, areas of the market where very distinct, sometimes technical, but very specific innovation is happening. So, for example, Graham talked about machine vision in the industrial automation space. I'd urge you to have a look at the white paper he published. It's on our website in the literature section, I think, in our fund section on the Amati website, where we talk in some detail about all the innovations happening in machine vision and the cluster of companies that are benefiting from that, including Zebra. So it's a great piece of work that Graham published, and I think you'll enjoy reading it. And equally, PTC is more about digital software tools for industrial manufacturing. When something becomes a theme that is so recognizable, you can name a fund after it. It's probably reasonably well discovered. We like to look in a fair bit more detail and kind of into the weeds, if you like, when we look for opportunities.
That's excellent. Thank you for that. We have a question here just asking about geographical split of the fund, and obviously you kind of covered that on one of the slides, and having quite a sort of large US bias. Would you sort of feel that's kind of representative of where the fund might be on a longer term basis? Or could that radically change, I guess, might be the question, what the question is getting at.
I think it's not, where we are at the moment. It will move around. It depends. Obviously, we have 31 holdings. If you sell one and buy something else, you can move the split by a reasonable amount just with one or two different holdings. So it will move around. But the thing to bear in mind is that the US is an incredibly deep market. There are a lot of really interesting, very innovative sort of mid-cap companies around that $10 to $30 billion mark. The part of the market we're underexposed to really is Asia. And that's partly to do with the fact that we have quite a strict approach to what we call ESG-H, the H being human rights. And a lot of the companies that we would look at that we think are very innovative based in China, we exclude for that reason. So we are a little underrepresented in Asia, and it's an area we'd like to find more interesting ideas, but we're a bit restricted by that sort of human rights approach. But I think that the split overall is probably not a long way away from where you can expect it to be.
Excellent, thank you for that. We have a question here. Mikhail, you talked about taking insights from the UK smaller companies team and the Amati advantage. Why is it that you don't get involved, or do you get involved in any stocks that the UK smaller companies team are involved with?
We do. So we have two holdings at the moment. One is a media company, Future PLC, which is well known in the UK as a publisher of specialist kind of interest-based periodicals. We like it. We know this company extremely well. We own it in the UK funds, but we also have like a global vantage point on the stock, which is we think the digital advertising is a huge pie of dollars, and maybe about a third of that is spent in what's called open web. These are adverts that pursue you around the web retarget you, as the industry calls it, around the web. Jumping from Daily Mail website to Guardian website to another general interest website you might be visiting. And because of the changes in internet privacy, the phase out of cookies, phase out of mobile targeting mechanisms, this industry is really in turmoil. And a lot of these dollars will go somewhere where they can be spent with confidence that they're facing the right audience, and they're facing that audience in a kind of privacy respectful, permissioned way. And the industry that emerges the best in that space is interest-based periodicals. If I'm visiting a magazine website dedicated to electric guitars or boat maintenance, it's very clear that that's the area I'm interested in, and it's very clear to an advertiser that's a great place to place digital ads. And I think that business will grow and grow for future. And the other company we own in the UK, Indivior, is a specialist pharmaceuticals company focusing on addiction treatment. And again, we see a real paradigm shift globally in the addiction treatment becoming less of a kind of a law enforcement penalty for crime, and more about realization that addiction is a disease and should be treated as such. And the frameworks, the growth and treatment is expanding as a result. And Indivior is the global leader in that space.
Excellent, thank you for that, Miguel. We have, I think, one more final question. This is more about kind of team, and really someone asking, how does a team of 3 cover a whole global universe?
Yeah, I think that's a very reasonable question. And both Mikhail and I have worked on much bigger teams in the past for running not dissimilar portfolios. The point is, though, that what we're trying to do here is find a small number of very innovative companies and hold them for the long term. So there are 31 holdings on the fund at the moment. We can hold up to 40. So we're looking to hold them for long periods of time, 3 to 5 years plus. So the turnover on the portfolio is going to be very low. We're not trying to cover the waterfront. We don't need to analyze and cover every company. We start with an innovation frontier, which we think is, has longevity and is driving a real change. And then we create that frontier of different companies that are exposed to that, the cluster, and then dig into that to find the company or companies that we think are the biggest beneficiaries. So that process is something that really needs to be done by an individual, and we don't need very many of those. And 3 people is, we think, more than enough to provide the really interesting stocks for this portfolio. And obviously, if in larger teams things get lost in, there's a lot of communication and a lot of meetings, and we don't do a lot of that. We're very focused, and we think it's an ideal number.
Excellent. Thank you. I think we're all done now on the Q&A. So really just thank you very much to everyone for joining and listening in today. It's very much appreciated. I hope you found it very interesting. Any more questions, please do get in contact with your sales contacts, as you can see on the slide. And as Mikhail says, please take a visit to our website, Amati Global, and look under the Strategic Innovation Fund, and you'll see the section there called Innovation Frontiers. And these are the papers that Mikhail and Graham have been talking about, quite in-depth papers, and there's 2 so far written, and they're topics they would have touched on during today's presentation, which is modernisation of electricity infrastructure, and then the other one Mikhail referred to, machine vision. So please do take a lot. So thank you very much, everyone, for listening in. Thank you for the presentation, and speak again soon.